So if you've been following the news recently and the announcements from the RBA, you would know that they're looking to keep the cash rate the same at 0.1%. The focus of the RBA and the government is to keep Australia moving and to encourage recovery as fast as possible. We've seen so much stimulus this year and mortgage interest rates are at an all-time low. So in the context of home loans, this begs the question, should you keep your interest rate variable, fix your home loan, or do a combination of both? Hey guys, welcome back. My name is Fyzee. I make videos about Australian personal finance, and today we're looking at fixed and variable interest rates in the current economic situation. Now, once again, this is not financial advice. We're looking at things from a general standpoint only. So before we start, let's recap what we saw in June last year. This article from the Sydney Morning Herald said that the rates would stay low for a few years, and this was said by the RBA governor himself. Now, this article is pretty old, so let's forward a few months to November 2020 by an article from The Guardian. Philip Lowe again has said that they don't expect the cash rate to increase in the next 3 years. Now, as you guys know, in November, the cash rate was dropped to 0.1%, and this is in line with all the articles and all of the evidence. So if we go forward based on what we've seen, the interest rates don't really look to be going up anytime soon, especially when we need people to be out there spending to prop up the economy and to also encourage businesses to resume back up again, which would in turn lower unemployment. Now, personally, 3 years is a very long time horizon and a lot can change in just 3 years. However, I do believe for the rest of the year, at least, we should be seeing low interest rates. So what should you do exactly? Well, look, it all depends on your circumstances, your goals, and what you're actually looking to achieve. So first of all, let's look into variable interest rates. Now, the number one thing about variable interest rates is the convenience that comes with it. You are free to pay as much as you want into the loan or just pay the minimum, it's up to you. Or you can even pay lump sum payments into the account. If you work a sales job or you get some sort of a large bonus, you can just put it inside the home loan and save on interest. So that's pretty flexible. Ultimately, the bank is making less money if you pay your loan quicker, but they are still happy to accept the higher payments because they're getting their money back pretty quickly. Most variable loans have a redraw function built into it, which means that if you've paid extra onto your home loan and you are at least one repayment ahead, you can redraw the money out of the home loan, meaning that if you've got expenses coming up, you can actually take the money out, which means that you have access to the money that you've paid extra and it's not just put inside the loan and it's staying there forever. So basically, if you paid extra on your home loan by 5K and you've got a bill coming up of 3K, that means that you can take the 3K out as redraw and pay your bill, and the 2K will stay inside the loan for the time being. Now, this means that you will only be ahead on your loan by 2K because you've taken the 3K out. Just keep in mind though, if you take money out of the loan, then of course you'll be charged more interest. Just keep in mind that although this is convenient, if you take money out of the redraw, then eventually you are paying more interest, so just be mindful of that. A lot of variable loans will have the option to package everything together and have an offset account as well. Now, this is very similar to a redraw, but it's an actual account. So if you've got $20,000 savings sitting in the offset account and your loan balance is 120K, the bank will only charge you interest on the 100K, not the full 120K. It's the same scenario if you had the 20K sitting in the redraw, and it just works very similarly. But the main benefit of the offset account is that you do get a debit card that's linked to the offset account, meaning that if you need to spend your daily transactions, you can do that as well and save on interest. You can generally access your money pretty quickly with the offset account, but with the redraw, it might take up to 24 hours, and some banks are not as quick when giving you access to the redraw funds. If you get a package loan anyway, you get the offset account and the redraw function built into it, so it's a win-win. Now, working in the finance and mortgage broking industry, I've dealt with thousands of customers and educated them on how all these things work. But the best part of a variable rate is having the ability to get your rate reviewed by the bank. You probably don't know this, but the banks have a special team there just in case if you want to leave the bank or refinance away somewhere else. I know because I worked in one of these teams. And I've given some pretty good discounts, but you simply can't do this with a fixed loan. You have to be variable. Speaking of refinancing, it's generally cheaper with a variable rate anyways because you don't have to pay a fixed break cost to leave the bank. Okay, now on to the negatives of variable rates. Now, since the rate can increase at any time, you're always vulnerable to that. Now, over the last 2 years, we have seen rates go down quite a lot. So a lot of people who are on variable rates benefited a lot from that. But eventually these rates will go up sometime in the future. So just keep that in mind. Now, the other thing which is very important is that when the bank cuts their interest rates, they literally announce it everywhere. They send you emails, they send you physical mails, they give you notifications, and they speak to news agencies about that as well. But when they increase the rates, it's not as prominent. A lot of lenders put the interest rate increases on the statements, and some lenders actually don't even give statements to their customers regularly. So of course, it's very hard to know if your interest rate has actually gone up. especially because most home loans run on autopilot, meaning that it's just a normal direct debit that people set up and they just pay their home loan without actually checking the interest rate every single day or every single month. So let me give you an example. Let's say that you have a $500,000 mortgage at 30 years on a rate of 2.5%. Your repayments will be about $1976 per month. But let's say that the rate has now increased to 2.7%. Your repayments will now be $2,028 per month, which is about an extra $52 or about $624 per year. Now, if you are on a very tight budget, you need to consider this, and this could be a very big factor for you. Generally speaking, if you do stay with the bank long enough, your interest rate will become outdated and you will pay a higher rate, while the same bank will be offering new customers a much more attractive rate, so watch out for that. So with fixed rates, you get certainty of repayments because your rate is locked in for 1 to 5 years or even more. So if your repayments are 2K per month, they will stay at 2K per month until the fixed term ends. So if you're someone who loves budgeting, loves tracking everything, and loves to know exactly where the money is going, this could be a good option because you know exactly what the repayments are every single month. Plus, you are also protected from any rate rises in the future, and there are some banks offering some really good rates for 1 to 4 years fixed. And of course, this is just to lock you in for the time being. But you do need to realize that with fixed cost comes with a lot of costs as well. If you find a good rate somewhere else and you're locked in with a fixed rate and you're looking at refinancing, the bank is going to charge you a break fee to actually leave the bank, plus the normal refinancing costs. Now this break fee could be a couple of $100, a couple of thousand. Some customers even have it in tens of thousands, or it could be zero. It really depends on the bank. Typically, the closer you are to your fixed term, the lower the break cost is going to be, but then again, it still changes with bank to bank. But if you're someone who likes to refinance every couple of years, then staying at fixed might not be the best option for you. If you want to pay extra on the fixed loan, there are a couple of restrictions as well. And these restrictions often have a massive difference between the banks. For example, for a 1-year fixed rate, ANZ will only allow a maximum of 5K to be paid before any extra costs, but Westpac will allow up to 30K extra, which is a huge difference. Plus, there are only a few lenders in Australia that allow a 100% offset account with fixed, and many lenders don't allow redraw as well, so really think of the costs that come with fixed rates as well. But let's say that you accept all these factors and you're happy to lock it in for 1 year, 2 year, or however many years. Once the fixed term ends, I've seen many customers that get placed on a very high variable rate, and this is something that you might not realize, so be mindful of this. And if you like the best of both worlds, check out a split loan. A lot of banks offer this, and it can give you flexibility to control your finances and split the way that you want it to be split. If you have a decent income, you could do 80% variable and 20% fixed just to pay more of the variable portion. But even if you don't have a high income and you still want to pay off your home loan ASAP and just smash the mortgage down, then you do need to have some sort of variable component in there. Traditionally speaking, variable rates have been good if you expect the interest rate to drop lower. But seeing as though we are very close to a 0% cash rate and the cash rate doesn't seem to be going down any further, it may be a good time to fix, up to you. Or you might just want some sort of certainty with your repayments, and maybe you're expecting the rates to go up sometime in the future. Therefore, you can choose a fixed rate between 1 to 4 years. Ultimately, it depends on two things. Number one being your circumstances, and number two being what your outlook is long term on where the interest rates are heading. If you're not sure what to do, you can always do a combination. A lot of people do 80% fixed to keep the large bulk of the loan at a super low rate, while having the 20% at a variable interest rate with the offset account and paying extra onto that one, while keeping the bulk as low as possible. But with this strategy, if you do decide to refinance within the fixed term, it could be more costly. But if you intend to stick with your bank for the entirety of the fixed term, then it could be very beneficial. Or you can do a 50% variable, 50% fixed, and kind of hedge yourself both ways. There's no perfect solution to figuring out the optimal setup, but it's more important to know how things work so you can make an informed decision. I really hope this video was helpful. I'm going to be looking at the RBA announcement very closely to see what happens. Thanks for watching, guys. Please like, share, and subscribe if you found value in this, and I'll see you in the next one. Thanks. You probably don't know this, but the bank you probably